Global indices generally have been on a good run recently. The DAX is at multi-month highs. Across the Wall Street's major indices have all been enjoying all-time record highs. By contrast, the FTSE's been a bit of a laggard. How should we be positioned, though, in the big picture? Serge Berger joins us now from the steadytrader.com in Zurich. Serge, good to talk to you. I know that Dow theory suggests that when indices all agree, there should be a consensus that the trend is going in the right direction. And as I said, Wall Street's seeing those records for the Dow, the S&P and the Nasdaq recently. Here in Europe, the DAX and also the French benchmark, the CAC 40, have been on a great run recently. What are you highlighting for your clients at the Steady Trader about global indices?
Hey, Jeremy. I think for the most part, what we're seeing here is we're seeing another basically central bank supported rally that has probably gotten a little bit over its skis in the short term. Let's call that duration 2 to 3 weeks, maybe a little bit more, particularly in the S&P 500 and in the German DAX. And if we look at this first chart here, you can see those two, S&P and the DAX, being dramatic outperformers, although very much in sync with each other, but out of sync with the UKX, also known as the FTSE, which of course there's some other things overhanging there. So the overarching thing for me here is just, I think those S&P 500 titles and the DAX are probably short-term overbought.
Well, let's pick those apart then and take the S&P 500 first if we can and talk a little bit about those. As I said, these all-time record highs. Yep. I was listening recently to some commentary from UBS suggesting that there's still 3 more interest rate cuts coming according to their chief strategist next year. And that would seem to be feeding through into this idea that record highs can continue. Just take it apart for us if you can in terms of the chart and indicate what you're talking about in terms of your client suggestions on this.
Certainly. In terms of the interest rate, though, just real quick, our base case is the interest rates will go much lower over time in the U.S. It's both a global economic phenomenon and also a demographic thing. But the S&P 500 here, if you look at the long-term chart as weekly increments, you can see we are at the very upper end of that channel. So that's the very simple view, and basically, historically speaking, as you can see, there's really no precedence for those being sustainable. Now, if you dig a little bit deeper into all this, and I'm going to make it what's called a daily chart, you'll see that that recent run, let me zoom in a little bit closer for you. You can see that that recent run here has basically now left this index well above its medium-term moving averages, like your 50-day and you kind of your standard moving averages, but also dramatically above your very near-term 8 and 21-day moving average. So the short-term bullishness has now been something like 4 weeks in a row, according to my proprietary indicators, and that is extremely overbought. You take that with a VIX that's essentially collapsed, record shorts on that, and I do think we are due for a pullback. Question, of course, is how deep? Well, your garden variety pullback here would probably call for something like a 2 to maybe 5% pullback. So the S&P 500 from these levels back down to 3,025. I would think something like 2,950 is probably a bit more filling. But then ultimately we would probably see another rally higher into year-end.
Okay, taking up on that short trade positioning, where would you put your stop there? Because would it be a tight stop over recent highs, or are you going to give it a bit more room to breathe?
It'll probably be a bit more of a breathing room, but it's more of a time stop. Right. So as opposed to a price stop, which I think is something a lot of people don't do. So basically here at these levels, it's very difficult to see a whole lot more upside. But if you were to see, stocks can consolidate in time sideways or in price lower. So if the time consolidation in sideways action would happen, then I would think something like a 2 to 3 week time stop would probably be the thing that I'm looking to do. In fact, that is the thing that I'm looking to do.
Absolutely. Let's turn to the DAX, if we can, to take a look at that particular index. It's widely traded. We know that lots of traders like the DAX. There's a bit of volatility that is applied to the DAX over some of the other European counterparts. And we've seen highs, I think, now something close on 11 months.
No, indeed. So basically, if you look at the DAX, it's obviously nowhere near the all-time highs of the S&P 500, although I will argue that I think European stocks are dramatically, or U.S. stocks are dramatically overbought versus European stocks. If you look at this to a multi-year basis, if it's something like 2 standard deviations above the mean, usually just literally never happens. Having said that, the DAX here, really what's more concerning is the short-term chart. So I'm going to make this a daily chart so you can see this a bit more, and it very much looks like the S&P 500. We saw that earlier when we had the multi-asset chart. And here too, it's essentially one of those things where, again, dramatically over its 50 and 100-day moving averages, but also above its near-term moving averages. And from a momentum perspective, we have your simple, things like your MACD basically at record high levels. Here too, same story like the S&P. I would think here it wouldn't be all that difficult to get a 2 to 5% correction. We are so far here today down about 1.5% of the recent highs. But I think, if you take the entire move, I just don't see how, a 5% pullback would be any big deal getting the DAX back to, 12,600 or something like that before we then get another move into year end. Then this time stop here would apply as well.
Yeah, and I know as we've spoken before, we're talking here about technical analysis. I want to introduce the concept of fundamental analysis as well to when taking a look at the FTSE 100, because clearly here in the UK, circumstances are extraordinary for a number of different reasons. And the FTSE, as I said at the top, has been a laggard against other major global benchmarks. How do you go about trading this sort of environment, or as a trader, should we avoid what's happening here in the UK?
Well, I think it's just I tend to shy away from very newsy situations. So whether that's on an individual company that has, let's say, a major outstanding lawsuit, like Boeing, for example, right now, to me, it's kind of a no-touch.
Sure.
And it's a similar situation in the UK. As much as I'd like to do a trade, doesn't mean that you should do a trade. So there's a lot of potential, there's a lot of abstinence or just, restraint that I think one has to exercise here to not do a trade, because there is plenty of stuff to potentially do a trade for. I just don't think the reward to risk is there, personally.
Yeah. Okay, well, look, we'll leave it there because that's a good point at which to say we're going to stick clear of the FTSE 100. But thanks indeed for your thoughts on some of those other indices where we've seen those recent highs and how to trade them. That's Serge Berger there joining us now from the steadytrader.com in Zurich.